Welcome in. My name is Arya and I don't waste your time, so let's get straight into it. In today's video, we're going to be ranking big tech companies in accordance with what I expect their stock returns are going to be in the next 5 years. Now, this is going to be similar to the tier list video I did a while back, which you guys really enjoyed. Again, we're over here on Canva, but this time it's going to be very straightforward. We're just going to rank them from 10 to 1. In terms of purely what I believe the stock return of these companies is going to be over the next 5 years. Just as a heads up, I forgot to do this at the start of the video, but the reason we're doing this video altogether is this is part of the Patreon that I have, which you can get a free trial to join with the link in the description. But as a part of this, you guys can give me video requests. On top of that, you guys can choose on a stock for me to analyze. We do these roughly bi-weekly, even though it's called the monthly both. There's more exclusive videos on top of that. There's a Ask Me Questions sort of Q&A thing as well. But yeah, if you're interested to join that, we have, I think, close to 250 members. So you can use the link in the description down below to try that. Now, of course, there's only quote unquote 7 big tech names, but I decided to bring in Netflix, ASML, and Uber to kind of round out our list and have a sort of top 10. And then the way we're going to be ranking these is first and foremost based off of the growth of the business. That's obviously going to be very important if you're looking at a sort of medium to maybe long-term outlook with these businesses. It's going to matter what their bottom line growth, their revenue growth, all that type of stuff is probably going to be. Additionally, we're going to look at valuation. Growth is one side of the equation, but if you're buying into a business at 200 PE, and then over the next handful of years, it doesn't really matter unless obviously you're going ridiculously fast. But if you're going at like 20%, but you trade at a 200 PE, that's going to be reflected in the event that there's multiple contraction with that business. And then of course, how predictable is this business going to be, right? So we're going to try our best to have a relatively accurate guess into the future projections of this business. But at the end of the day, there's a tier of, there's an element of uncertainty that comes with particularly one of these businesses, which we'll dive into as we go on here. And of course, all that is going to be done on finchat.io, which is the world's greatest stock research platform. Link in the description if you'd like to try it out completely for free. Now, for starters, we're already on Tesla here, but I think between these names, in terms of which one I think would come last, it would actually probably be Apple. So we'll start off with Apple, and I'll kind of give you guys my case as to why I think Apple's going to probably have the worst returns. So first and foremost, this is a company, and maybe I could demonstrate this with the total revenues growth. This is a company that has historically, you know what, we're going to go over the charting tab. So this is a company that has historically done exceptional for shareholders. You look back over the past, since the birth of the iPhone, revenues have climbed higher and higher year after year, no problem. It's been a phenomenal business, no doubt. But the issue is that over the past 4 years, and you might start to notice that revenues have kind of flatlined. And I've consistently heard from Apple shareholders that there's going to be an upgrade cycle. Sooner or later, people are going to start buying their hardware at an accelerated pace, this and that. It's a services growth business, whatever the case may be. But as of right now, it still hasn't shown up in the numbers, and I have no reason to believe that this revenue is going to reaccelerate. So if we pull up Apple's revenue growth, it has climbed out of the sort of slightly down -3%, 0% growth. We are growing about 2-3%. Another myth that I hear with Apple is that they have a very strong buyback program. Historically, yes, they had a very strong buyback program of, north of 6-7%. But for the past couple of years, it hovered around the 4%. And then especially recently, it has been much lower. It's been 2.6%, 3%. As of very, very recently, like this past month, because the stock has crashed a lot, it is getting back to those historical levels. But again, this, even let's just call it 4% buyback yield, it's not going to excuse for the 3-4% in revenue growth. And then at the same time, and perhaps I could demonstrate this to you guys better over here, we have this comment size feature on FinChat where you could go, it shows you that item as a percentage of the total row amount. So for example, if you take iPhone revenue and you wanted to know like how much of Apple's revenues are iPhone revenues, you'd have to do 200 divided by 395. Instead, what you could do is you just click comment size, and then now we know it's about half of the revenues. And it's declined as a percentage, but still. One last thing I'm going to add here. Let's do services revenue growth, right? So this has been the highlight of Apple's existence, and we're spending a lot of time on Apple, but I think it's important to note. So let's do annual view. Yeah, there you go. So historically, the services growth was where it was at. But again, as you can see, since roughly, late 2021, 2022 period, the growth has started to slow, and it has reaccelerated from the bottom in 2023, but still, this is lackluster. This isn't going to excuse the fact that the rest of the business just isn't growing altogether. So those are my thoughts with Apple in particular, and that's why I'm placing it last. I think in terms of growth, definitely lacks there. And oh, we completely forgot, valuation wise, it came down recently, but like it still trades at 32 times earnings. So you have an excuse of a business in terms of growth, valuation's expensive, and then in terms of predictability of like, they'll retain their revenue and earnings. I just don't think it necessarily matters in this case. I'm looking down the list here, and honestly, even though I'm somewhat hesitant to do this, but I think I'm gonna have to place Tesla next up, and this is purely based off of there's a huge amount of actually it kind of hits all three of them. They're just awful across the board. So predictability is just awful with this business. Especially as of recent, and perhaps it's a little bit of recency bias in terms of how they've been performing in terms of cars sold. So let's do the production number, right? This in of itself hasn't moved in the past 2-3 years. And, Elon Musk in 2021 was saying they basically see 50% growth forever. Obviously, that hasn't came into fruition at all. If you go over on a quarterly view, this was actually their first real decline at scale ever, basically. And, it's up to you to decide whether that's due to Elon's political affiliations or whatever the case may be. The fact is that the company is materially being impacted at the moment. And on top of that, we've had the past 2 years where there really hasn't been much increasing demand for their products, right? They've kind of hovered around that 1.7, 1.8 million cars sold per year, and it's been like that for the past 2 years. That naturally flows over to the revenues. I will admit their energy segment. So, okay, I'll fully give this to them, right? So their services segment and their energy storage segment, these two is a cluttered chart. Let's go on last 12 months view. These two are growing incredibly well. So the services segment growing at roughly 26%. This is FSD and a bunch of other stuff. Energy segment is growing 67% over the past 12 months. That's absolutely incredible. The only issue is this is still predominantly a automotive business. So if we do total automotive revenue, energy, and services, give or take 79-80% of the business is still automotive. The other two roughly make up 10% each. So energy was a very small portion of the business, but is now making about 10%, and it's growing much faster than the services business. So I'll give them that. There is diversifying revenue streams, but again, like you take all that into account and you look at the total revenue growth rate of this business over the past handful of quarters, it has been zero effectively, right? So it's definitely a bit of a struggle on the growth side. And then what doesn't really help you out here is that based off traditional valuation metrics, which like I'm a little bit hesitant on using, particularly with Tesla, just because like they could be in the low of their investment cycle, particularly with free cash flow valuations. Again, net margins, I would be a bit hesitant on using that, but like at the end of the day, even if you assume, let's do this should be a fun little comparison. Even if you assume 100% of their gross profit becomes net income, which is like, that's basically assuming the only cost for your business is actually making the car, not to mention, making these factories, any operating expenses of literally anything, like you have 0 employees to pay off or whatever the case may be, right? Even if we assume 100% of 100% of gross profit turns into net income, you're still trading at a 45 times PE multiple, that's impossible, right? And so that kind of, this EV to gross profit kind of clues you in of just how expensive this business actually is. And it's definitely not as expensive as it was in 2020 and 2021, but the point still stands as it currently stands with the way the business is today. This is a very expensive business. It's a very expensive business that is unpredictable, and they have next to no growth to show for it. The only reason I'm placing it above Apple is that there is a 1 in 10 chance that either they figure out the Optimus robot thing and that balloons up, they figure out robotaxis and they're a real player on that market over the next 5 years, and that causes some level of unforeseen growth. Or I think what's more likely is that FSD gets solved. They see a huge amount of user adoption with the pre-existing amount of cars that they've sold. On top of that, you have the energy business coming online. And so I think those components of the business are going to be more important for this company on a going forward basis. And at the same time, I think it's just going to hold on to its valuation premium. So overall, I think Tesla, as crazy as it sounds, is probably going to outperform Apple over the next 5 years. At the same time, there's always the chance that like Tesla just balloons up and, triples for no apparent reason. It just, the valuation goes from 40 times gross profit to 150 times gross profit, and it outperforms everything here. But I think just looking at it from a rational standpoint, I think Tesla is probably one of the worst bets among all these names. Next up, and I honestly, it's just because there's so many other great names here. I'm stuck between Nvidia and Microsoft. And Microsoft just because the growth isn't there, and I'm considering Nvidia because the predictability isn't really there. But I think this is very difficult. I think I'm going to have to put Microsoft 8th. Again, it's nothing against Microsoft in particular. Fantastic company. I think it's going to outperform the market altogether. But the issue is, They're only growing revenues 12, 13%, 15%. Okay, I actually didn't know that. But that translates to roughly 15% margin growth, operating income growth. In terms of stock performance, Google's in the mix as well, because I'm not sure Google's going to do much better than 15% over the next handful of years. But at the same time, Google's valuation is much cheaper. So I think, yeah, I'm gonna keep Microsoft at 8 because I estimate that they'll grow earnings at about 13, 14, maybe 15% over the next handful of years. Trades at a 30 times trailing PE. I don't see much room for operating margin expansion or like new business lines. It's incredibly predictable, so we'll definitely give them that. But I think you're looking at a low to mid-teens stock performance over the next 5 years. And yeah, I think that's very deserving of the number 8 spot. Next up, again, it's very difficult to choose just because the unpredictability factor of Nvidia, but I think they'll be able to continue to grow over the next 5 years. So I think that alone will warrant Nvidia to be much higher on the list. Next up, I'm going to have to put Google. Or Meta. This is very difficult. Okay, this is probably the most difficult part of the list. Okay, let's compare the two. Let us compare the two. So, should we do PE? I think I'm gonna do EV to EBIT. So EV to, maybe we'll do PE after as well. As it stands currently, and I don't think this keeps up with Meta, but they are currently growing much faster than Google. But I think on a forward basis, they're probably gonna grow revenues about 15, 16%. Google, on the other hand, is already growing 14. I expect them to average of 14% CAGR over the next 5 years. I think that seems reasonable. In terms of Meta, they're trading at 20 times operating income, while Google trades at 16 times operating income. So you definitely have the valuation there, and I think Google can re-rate higher, but I would assume Meta just goes up with it. So all else equal, I would, even though I'm invested in Google, like I have a huge amount of my portfolio in Google. Yeah, I have just shy of 20,000 invested in Google. It's a roughly 20% position for me, so it's a very significant portion of my portfolio. But at the same time, I think you just based off of the numbers we have now, right? I think you have an easier argument if Meta keeps up the growth rate. I think Meta could probably still outperform Google. The issue is that I have a hard time predicting Meta's future revenue growth. With analyst projections, they're saying revenue grows at about 14%. So it's roughly the same revenue growth over that's only the next 2 years though. If we bring in revenue percentage change, they're projected to do 14, 13, 12%. Google is like basically the same thing, but just cheaper. And Google has the opportunity to expand margins a lot more than Meta. I think I'm going to have to give the edge to Google here and rank Meta. Oh no, okay, interesting. But I don't know. I think they're incorrect. I think Meta probably does grow a couple percent faster on revenue side than Google, but at the same time, Google has a lot more opportunity to grow their margins. So it's very close, but I think perhaps I'm biased here, but I'm going to put Google at 6 and I'm going to put Meta at 7, even though I think they're both probably going to do north of 15% in terms of stock performance over the next 5 years. Okay, this is getting very interesting. So let me actually move this. I don't think you guys were able to see that the whole time, but there we go. This is starting to get interesting. I think between all these companies over the next 5 years, this is very difficult because I think they'll all do above 20%, but I think I'm going to have to put Netflix at 5 here because of the multiple. So predictability, that's difficult. Netflix or ASML? I think I'm going to leave Netflix there just because the multiple is so high. Because if that gets a re-rating, then things start to become worrisome. So if we pull in Netflix here, we could do a bunch of different stuff. I'll just do EV to EBIT. Let's do trailing PE. Let's do EV to free cash flow as well. But I mean, no matter how you flip it, Jesus Christ, that is an ugly chart. No matter how you flip it, and free cash flow, maybe we don't do that one just because I'm sure they're spending a boatload on content. But here we go, 46 times trailing PE. So other than Tesla, that's the highest PE that we've looked at over the course of this video. 38 times trailing EV to EBIT. So we're just looking at Meta. They're trading at 20 times. Google's at 15 times. And so Netflix's multiple is unbelievably high compared to the rest of them, but rightfully so, right? Like this is a company with 90% plus retention of revenues. They have the advertising thing. There's a huge amount of optionality that comes with the business. The predictability is just out of this world. So it definitely deserves to trade at a premium. I'm sure it'll trade at a premium in the future, but at the same time, they have the most to lose. And I think that should be factored into our valuation here as well. They currently have 30% operating margin, so decently high, but I'm sure they'll incrementally gain on that. They're currently accelerating revenues. I think in the future, they'll probably average that mid-teens revenue growth rate. Let's take a peek. Yeah, I think it would be reasonable to sort of project 14, 15% revenue growth, a little bit of margin expansion. So organically, you're looking at maybe a high teens EPS growth rate, maybe a little bit more than that if they could expand margins higher than anticipated. Again, it just goes back to that valuation risk. I think organically you have close to 20% EPS, free cash flow, operating income, whatever you want to choose on the bottom line. And then it really I don't think you'll get incremental gains from the multiple going up. So you're really just relying, in order to achieve that 20% stock CAGR, you're really relying on the PE staying at like 46, 48, whatever, right? I'm not sure that's a bet that I'm willing to take, but I think they could still outperform the rest of these companies here. Moving on, I think ASML comes next. ASML? Yeah, I'm going to put ASML here because ASML or Amazon currently trades at, this is just absolutely ridiculous. So I'll show you guys on the chart here. And we'll just do trailing PE just because keep it simple. I wouldn't look at pre-2019, and maybe I'll show you why we shouldn't look at pre-2019. If we bring in total EUV sold, this has really become a different business post 2019. You'll see that prior to that, and the China trade war stuff really brought the valuation down during this sell-off here, but like during the roughly 2018-2019 period, that's when they seriously started to ramp EUV, and it really became sort of mainstream to be recognized that this is like the EUV company, and like they just kind of ran away with it in terms of the lead they had over competition. And so I think naturally that should cause a re-rating of the business coming out of 2019. And so when you're like looking at valuation for this company, I wouldn't necessarily look at like the full decade, right? And so you'll see, you know, this 30 times trailing PE, which like it just looks crazy, but at the same time consider that like this is like actual PE. They don't have high stock-based compensation or anything like that. At the same time, it's like a monopoly manufacturer of EUV machines. But anyways, you'll see like this 30 times trailing PE area is usually the cheapest it has gotten over the past handful of years. And this is when I initially bought my position in September of 2023, which actually it's at basically the same price, kind of crazy. But yeah, when I initially bought into the company back then, it was trading at like 29-ish, 30 times trailing PE. Same thing back here in October of 2022 when we bought them during the sell-off. During the pandemic crash, again, same thing, 30 times trailing PE, right? So this 30 times trailing PE area is, at least from the multiples chart, that's where it usually bottoms at. And even if the valuation was to continue to slide, which it's very possible, where's it going to really, like realistically go down to, right? This is a very wide moat business. I doubt that it would go down to like 20, low 20s trailing PE. Same thing could be said, by the way, for operating income and that respective range of valuation. Right? So today you have 29 times trailing PE, 23 times forward. It's a business that it's projected to do about 20% EPS growth over the next 5 years per year. But honestly, I think you have a wide range of possibilities with this company. Given the cyclicality, you could choose any given year and whatnot. But I wouldn't be surprised if 5 years from now, we're looking back at this company and you see 20% revenue growth per year. Just given global chip demand, global AI demand, as that rises, I wouldn't be surprised if things accelerate over at ASML's business. You have massive inherent margin expansion baked into the business model, just, you know, being the monopoly supplier of these machines. They earn incredible margins on it. And then you have like a services business tied in here that like once you sell the machines, there's a good chunk of repairing and added software upgrades and stuff like that they can do to make these machines more efficient over time, right? So it's a truly remarkable business. The valuation is probably at the bottom of where it's going to be over the next 5 years. I really don't foresee this business becoming any cheaper than it already is. Yes, there's some cyclicality to it, but they retain their earnings and their revenues during the downturn and then during the upturn. And you know what? I'll just show it to you guys. Why am I even explaining this? Here we go. This is the revenue growth over the past decade, right? So you have your years where it's 8% growth, it's 9% growth. This most recent year was only 3% growth, but then it's followed up by like an 18, 30%, whatever, right? So, and you could go back 20 years. It's essentially been the same thing, right? So we're currently in the quote unquote down year. Wouldn't be surprised if next year things start to jump even higher than what's projected, right? With that, I think without a doubt, maybe not without a doubt, but very easily this could be 20% just organic growth rate from the earnings of the business. And then you add on that there could be a decent amount of margin expansion. You know, if this company creeps its way up to a 35 PE, 40 PE, which historically it's been at a 35, 40 PE, all of a sudden you're looking at like very easily a 20% plus return in terms of the stock CAGR. As I'm pitching this to you guys, by the way, I'm kind of thinking like I don't own enough of this business. Currently about an 11% position. I do have a decent bit of cash that I could allocate to this, but I don't know. Probably should end up buying more. Like the stock hasn't moved since I started buying into it, but that'll be a video for another day. Moving on, this top three is very difficult. if I'm being very honest, just pure stock performance, right? I think I'm gonna have to go in this order. I think I'm gonna have to put Amazon third, unfortunately, even though it's literally my biggest position. And we'll just do the top three in one go here, and then we'll talk about them. I'm gonna do Uber second, and if we're being honest, Nvidia with the growth profile that it has, I think that'll have to be first. And so I'll kind of talk through this here. I did Amazon third because I think it's the interplay of two different things at the same time. One, it's the cheapest multiple it's been ever. And of course that's due to margin expansion, but it still doesn't really negate the fact that it is in fact the cheapest multiple it's ever been. I think organically you have a pretty lackluster revenue profile. So it's only about 11% growth in terms of revenue, but what you have to understand with that is that, the bulk of the revenue from this business is coming from the e-commerce side of the business. So if we click on common size here, their online stores revenue is 40% on its own. Third-party sellers, which is, I guess, kind of tied in with that, 25%. And then the two high margin portions, I would say three high margin portions of the business, advertising, subscriptions, and AWS, those are all much smaller revenue components of the business. And then if we just simply toggle on, these three parts of the business, I think advertising only got broken out in 2019. But you could see with the three of them, they're taking share in terms of revenue against the other components of the business. What that means is these three parts of the business are growing much faster than the other parts of the business. What's great about that is that these three parts of the business are by far the highest margin parts of the business. So I mean, AWS alone accounts for 60% of profits. And then on top of that, AWS's margins are like about, I want to say 40%. This is custom metrics, by the way. It's a recently added feature and it is incredible. And you should absolutely try it out. Again, 2-week free trial using the link in the description. Yep. So as of the most recent year, it's a 37% operating margin business. And of course, that's on accelerating revenues, accelerating operating income, just everything, right? So it's the engine of the business is the AWS component. And so with that, you go over to like the operating income of the company and we pull up the growth of that side of the business. It does look a bit weird, again, like just because of the huge margin expansion over the past little bit. So if we take a peek, it's growing at 86% year over year, which that's not going to continue. And of course you have like negative comps back here as well. But I think operating income on its own, just purely because of advertising and AWS and that type of stuff, it can easily be growing over 20% and actually maybe even more, right? And then you add on like maybe any amount of efficiency gains in terms of the e-commerce side of the business that adds to the amount of margin expansion that they can kind of pull. Additionally, like the multiple is not that bad, 35 times trailing earnings, 30 times forward, EV to EBIT or price to operating cash flow, whatever you want to use is sort of on the lower end of it. So you have the opportunity for a decent amount of margin expansion at today's price. They're going to be growing 20, maybe even 25% operating income over the next 3 to 5 years. And so very easily you could kind of foresee that the stock can return between 25 to 30% per year at today's prices. But then at the same time, you have Uber here, which this company, I should really make it my top holding at this point. I really don't believe in the AV risk. And actually, I'll sort of document just some recent news with Uber. So why is Uber trading at a discount, right? It trades at about 20 times free cash flow for a business that's growing free cash flow about 30-40%. That's just absolutely unheard of. It's because the AV risk. So, Tesla claims that they're going to come online. They're going to just disrupt Uber out of nowhere. And I've done previous videos, actually maybe 2 videos ago. I called the moat untouchable. Yeah, here we go. If you haven't watched this video, it was a really good video. I kind of wish more people saw this, but one of my favorite videos I've ever uploaded. I'll link it at the end of this video if you want to watch that one after. But, the reason it trades at a discount, it's because Tesla with the AVs and that type of stuff, they're supposedly going to come out with this later this year. And over time, they're going to just be able to get rid of Uber's business altogether because obviously you're going to get into a Tesla robotaxi that costs $6 compared to the Uber that costs $10. They're just going to underprice them. They're going to be profitable where Uber can't be profitable and price them out of the market. Now, that all sounds fun, and it seems like that can very easily happen. Of course, Tesla's going to be able to do it. And if you go watch the video I made, there's a number of reasons why Tesla probably can't do that. And I'm willing to bet the other side of that coin, as I have. Uber's a 20% position for me in my portfolio. There's like the fleet management aspect of it. Who's going to charge all these cars? Are people really willing to send off their personal vehicle and have strangers sit in them? What if something gets damaged? What if they get the seats dirty? There's pricing algorithms to this. There's variance in terms of the demand during the day. Who's going to have all that data? And then at the same time, like Tesla really has a money issue at the moment. They don't have the capital to build all these things. So they're going to have to partner up with somebody. Turns out Uber is already partnered up with a lot of fleet managers. And so this is where this part of the news comes in. that Waymo, which is the other competitor, that's a whole nother argument. I think Waymo is going to beat them to the race. But anyways, Waymo recently launched in Austin about a month ago, and they exclusively launched on the Uber app. So if you want to get a Waymo in Austin, you're going to have to go through the Uber app. And then ride volumes within the first month, which is very selective and small amount of data that we already have, but it's still in the right direction and overwhelmingly in the right direction. Rider volume is more than 80% higher than the first month in San Francisco, which again, you're comparing the first month in San Francisco from over a year and a half ago when there wasn't as much buzz with AVs and that type of stuff. But like at the same time, San Francisco is a very tech savvy city. So I don't know, remains to be seen. But I think 80% rider volume is overwhelmingly in the favor of Uber. And it's going to only become more apparent in the future that, you know, if you are a company that has solved autonomous vehicles, if you're an Uber, a Waymo, if you're a Waymo, if you're Tesla, some of the Chinese players, Zoox, which is a subsidiary of Amazon. If you want utilization and you want go to market, you have to go through Uber. Uber has the fleet managers, they have the demand. It's simply a lever, which you just pull the lever and you have instant monetization and you have a business that's doing tens of millions of dollars in revenues right away. And then at the same time, even if you're able to do your own thing, in the case of a Waymo, it's better to go with Uber because you're probably going to get higher utilization rates. Again, it goes all the way back to the fact that Uber has all this data in terms of the peaks and troughs of demand throughout the day, being able to selectively send drivers into certain areas in anticipation of those demands or being reactive to anomalies and that type of stuff, right? So it's all these different things where Uber has built out the infrastructure for it. Lost items is another like miscellaneous thing that like Uber can deal with, because they have a decade of track record dealing with this type of stuff. So because of all those reasons, I think the AV risk is actually not that high. So in terms of predictability for Uber, I would rank it pretty high. On top of that, the valuation, we're doing this in reverse order, but should be fun. This 16 PE is a complete lie, by the way. This is because of a tax deferral thing that they got. It does trade closer to a 30 times real PE, maybe a 35 times real PE. So actually very similar to Amazon. How I like to value it is based off of price to free cash flow, and we'll do both here. So we'll do price to free cash flow or EV to free cash flow minus stock-based comp, and then let's just do normal EV to free cash flow, right? Okay, that might be glitched. I think let's just do price to free cash. Keep it simple. So as of now, Uber trades at roughly 21 times. Oh, I'm blocked. Here we go. So as of now, Uber trades at roughly 21 times trailing price to free cash flow. That's roughly a 5% free cash flow yield. And then if you deduct stock-based comp, it's a 30 times price to free cash flow. I'm not sure what that would be in a yield format. Roughly a 3.5% stock-based comp adjusted free cash flow yield. So basically the same thing as the S&P, right? The S&P trades at a similar free cash flow yield to that. So you have this business, which is trading at the lowest multiple it has ever traded at. And there's always the possibility where the valuation goes lower, but I rate that possibility very, very low. You have organic growth in free cash flows based off their own guidance, right? So they said 30 to 40% EBITDA. And you know what? I'll just pull this up as well. Let's see. This is a very little known feature that we have is we actually bring in the investor slides. This is a great investor slideshow, by the way. I recommend if you have the time to read through this thing. This is the thing I was talking about. Ride sharing demand is highly variable throughout the week. But this is, okay, so this is their own guidance that they issued. In February 2024, they said 3-year outlook in terms of gross bookings. So this is just your the order value of your Ubers. You could take this as a proxy to revenue growth. They said mid to high teens CAGR, so between like 15 to maybe 17, 18% growth there. They're currently growing 21%. They said high 30s to 40% CAGR in terms of adjusted EBITDA, which I don't like adjusted EBITDA, but then right here they say free cash flow as a percentage of adjusted EBITDA to be 90% plus. So, you know, if you're growing 30% in terms of EBITDA, that should roughly translate 1-to-1 in terms of free cash flow. And they're actually way above their guidance on that. So it's 106%. So that means free cash flow is actually growing faster than EBITDA. So when they say 3-year outlook of 30 to 40%, they are way ahead of that outlook. And your free cash flow of supposedly going to be growing 30 to 40%, currently growing significantly faster than that pace. And I think very easily the free cash flow could be between 35 to 40% growth over the next 3 years, even going into 2027. Of course, it's probably going to die down a bit from there, but nonetheless, like, you know, you have a business organically growing by then, maybe 15, 16% revenue growth. Even if you do a little bit of margin expansion, a little bit of buybacks coming into the picture, again, you're looking at like 20% free cash flow growth. So it's 30, 40% free cash flow growth for the next 3 years. and then 20% plus free cash flow growth for the 2 years after that, this is a home run investment is the pitch I'm trying to give with this. Even if the multiple goes down a little bit, which is, again, very unlikely, you're looking at a business that is probably going to get close to 30% stock CAGR over the next 3 to 5 years. Don't quote me on that, not financial advice. But no, I genuinely believe that, and I've invested my dollars that way as well. Finally, we're looking at Nvidia. You guys might be surprised I put this number 1, but it can very easily be the best performing of them all, purely based off of how much growth is left in the tank. As of now, Nvidia trades at roughly 40 times trailing earnings, about 25 times forward PE, which is just very cheap. At the same time, like EBITDA, EBIT, price to free cash flow, it all looks relatively similar if we want to look at it on that front. The part where things get a little bit questionable is the predictability of future growth. If you take analyst projections, which have consistently been wrong at face value, they're saying close to 40% EPS growth. That flows down to the similar amount of growth in terms of operating income, similar amount of growth in terms of free cash flow and that type of stuff. You're not going to get much margin expansion, I don't think. 62% operating margins is higher than MasterCard and Visa. Maybe not Visa, but I think definitely MasterCard. So I doubt that you get 70% margin expansion 5 years down the line. You get to 70% margins, but I think nonetheless, like you're not reliant on that. It's still a very incredible business. Of course, we want to make up our own predictions here over the next 5 years, but I think very easily you have a company that grows revenues north of 20%, maybe even a little bit more than that. You get a company that grows their revenues north of 30%. I know the projections aren't at that, but Jesus, they do so much. They do 130 billion in revenue. But I think it makes sense. I think over the next 3 years, you could probably squeeze out about 30% revenue growth. And now that I think about it, I think I'm going to knock Nvidia down. I'm going to put Uber as number 1. I think this is what a controversial statement, huh? But I do think you have to rely on a bit of a higher multiple with Nvidia than you do with Uber. I think Uber over the next 5 years has an easier time getting over 30% stock returns than Nvidia. I said it. I could very easily be wrong. I think these two are very close to each other. But again, I just think back to the multiple. It's trading at 38 times earnings, or whatever the equivalent is to EBITDA EBIT. It can very easily get a much higher premium, and Uber can actually go down, causing the delta in terms of stock performance. I could very easily see this go to 50 times earnings, and it deserves to trade at 50 times earnings. And then at the same time, Uber goes down to 20 times earnings. That can very easily happen, right? And I don't know, it's difficult. What's more predictable? Is Nvidia's revenues over the next 5 years more predictable than Uber's? I would have to say with the new tilt in terms of, that's difficult. Could we do a tie? But yeah, I think I'm overall happy with this list. Number 1 and 2 are very difficult to choose from, but I think overall it's good. By the way, we're using finchat.io the entire video long. I don't think you guys actually realize this, but this is not just like any other platform. You get a 2-week free trial. There's no card required, and then that's it. There's no catch. As long as you have a valid email address, which I hope if you're watching this video, you do have one. Otherwise, I don't know how you function in this world without one. You can go onto FinChat, sign up, and that's it. You get 2 weeks of the highest tier FinChat Pro subscription completely for free. And then on top of that, there is a free tier as well. So it's a little bit more restricted. You still gain access to all the data and that type of stuff. There isn't anything that's locked. More so the timelines, you're only given, like, for example, 5 years of historical data and that type of stuff. But it's not like there's anything locked behind a paywall. You still have the data, just on a shorter time frame. So again, go try it out. 2-week free trial completely for free. No strings attached, and I promise you're going to fall in love with the platform just like I have. It's the only sort of sponsor that I take on the channel, and it's because I genuinely use the product every single day, and full disclosure, I actually work for the company. While you're down there, you can also check out the Discord if you want to join that. I also offer you a free trial there. We have close to 250 members here, and thank you for watching, and have a great day.